Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Here's what we're watching in the stock market after a volatile first quarter of the year. Major U.S. stock indices have declined by 7 to 11% since mid-February. There is even more damage happening beneath the surface, with almost half of the stocks in the S&P 500 already trading more than 20% below their 52-week highs. From a narrower perspective, the Magnificent Seven tech stocks are responsible for much of the weakness in the S&P 500 this year. This is the fourth straight year that the Mag 7 stocks have driven more than half of the S&P 500 return, whether that's up or down. Meanwhile, the rest of the index is holding up somewhat better during this correction, and stable dividend growth stocks have recorded zero losses. Some investors may see the recent weakness in the Mag 7 stocks this year and think that it's a buying opportunity. But it's important to look at this from multiple angles. We saw this chart that relative to the S&P 500 valuation, this is nearly the cheapest that the Mag 7 has traded on a relative basis in the past decade. That looks compelling, but when you're doing relative valuation, you have to look at the attractiveness of the underlying asset that you're comparing it to. In this case, the S&P 500, whether you're using the whole index, the 10 largest stocks, or the remaining 490, are all trading 20 to 30% higher than their historic average valuation of the past 30 years. Looking at these 7 stocks on an absolute basis, they can decline by another 20% to reach the trough valuation recorded in 2018 and 2022. That also doesn't account for negative revisions to earnings growth. We still own 3 of the Mag 7, but combined they are only an 8% model weight in our long-term growth stock strategy. That's much less than the 30% weight in the index. Broadly speaking, we're concerned that investors are too optimistic about earnings growth in the years ahead. Since 2001, the companies in the S&P 500 have grown earnings per share at a 7% annual rate. That's not too different from the past century of financial results for the largest businesses in the United States. Compare that to what's expected over the next 3 years. Analysts project 12 to 14% earnings growth for 3 straight years. That hasn't happened in the last 2 decades, and we think those projections will be revised down in the next couple of years. Part of why we're skeptical about the 12 to 14% earnings growth projection is that we don't expect profit margins to expand in the next few years the same way that they did in the past 2 decades. Net profit margins of the largest companies in the U.S. grew from 8% in 2002 to 13% today. The biggest drivers of margin expansion during that period were declining interest rates, a falling corporate tax rate, and globalization driving lower labor and material costs. We don't expect any of those 3 drivers to provide the same tailwind going forward, and one or multiple of them could turn into headwinds. As a reminder, we still prefer large cap stocks over small cap during a choppy trading environment like this. We value consistent free cash flow generation from our companies. Small cap stocks are not nearly as profitable, with more than 4 times as many unprofitable businesses, and they are more reliant on a healthy economy to have to generate growth. Another subject we want to address is the outperformance of European stocks over the past 4 months. It's been impressive to see European stocks outperform US stocks by 20% since December. The outperformance could continue further into this year, but just know that all of this outperformance is coming from multiple expansion and not the fundamental outperformance and growth by the actual businesses in Europe compared to the US. We do own some European stocks in our long-term growth strategy, but they are stable businesses trading at reasonable prices like Unilever, Roche, and Novartis. So where do we stand after this 10% correction in the stock market? One metric we follow is the long-term appreciation potential for stocks that is updated weekly by Value Line. When upside is low, this number can be as little as 30 to 45%. When it reaches 85 to 90%, the market is starting to look more attractive. And when it reaches 140% or greater, like it did in 2020, the market is providing an amazing buying opportunity. Today, at 55%, some of the froth in the market has been removed, but we are still 15 to 20% downside away from reaching that next level in attractiveness for a long-term investor. Lastly, there is a clear difference between what the greatest value investor in history is doing with his portfolio compared to the average money manager. Warren Buffett and Berkshire Hathaway continue to have a record percentage of their assets sitting in cash, earning the short-term treasury yield. Meanwhile, the cash weight for the average money manager in the monthly Bank of America Fund Managers Survey is at its lowest level in 15 years. Normally, a great buying opportunity is when these money managers are increasing cash, like in 2008, 2012, 2016, 2020, and 2022. Today's cash level is far from that. We side with Buffett and will continue to wait for a better entry point to put our cash to work. We hope this gives you an idea of how we're looking at the stock market after the first quarter of 2025. If you have any questions, please contact us. We like to provide the information we think is most valuable to investors. If you'd like to see more of our insights, please subscribe to our YouTube channel.